The U.S. Court of International Trade has ruled that the Trump administration overstepped its authority by using emergency powers to impose tariffs, a decision with major implications for trade policy, inflation, and interest rates. Joining us now for a look at those implications, Gennady Goldberg, head of U.S. rate strategy at TD Securities. Gennady, thanks so much for taking the time. Let's start with that big headline so people can understand it. What exactly did the U.S. Court of International Trade rule on, and why is it significant?
Yeah, and then thanks for having me, Greg. The court basically struck down President Trump's ability to use the International Emergency Powers Act, IEPA for short, to implement that 10% barrier across the board. That kind of throws a wrench into the administration's trade policy. They were using not just that policy, but many, many others. So, what we view this as is just injecting even more uncertainty into what was already an uncertain process. I view this very much as kind of being in the eye of the hurricane. I think a lot of investors were hoping that kind of de-escalation that we saw with China a couple of weeks back was the start of, a period of calm. I think this reminds you that very much this is a live process, and it's going to take some time to resolve.
A live process that also means that the administration has 10 days to respond. What are the most likely paths forward for the White House after this?
Yeah, it's a great question. Certainly appealing the ruling. You've already seen the administration say they're going to try to appeal this to the Supreme Court as early as this week. That's certainly going to take some time. It may take more than 10 days. The backup option would be to use one of the other existing statutes. So to use the Section 122 statute that allows for a 15% barrier for up to 150 days. Now that's temporary, but it could provide kind of a bridge until the administration can use some of the other more permanent statutes like 232 or 301 once they've kind of completed some of their investigations into sectoral trade barriers. Now, that could take time, but in my mind, this injects a whole lot of uncertainty into markets where, markets were hoping for a little bit of clearing up rather than a step backwards.
When you framed it as eye of the hurricane, I had a picture of Jerome Powell sitting in that eye, looking at the swirling clouds, trying to figure out what to do about monetary policy. These developments, does it inform us at all about what we think might happen with inflation, what might happen with the Fed?
I think it just makes it even more complicated. I mean, Jerome Powell is lashing himself to the mast of the ship and hoping to do as little as possible to kind of give us any sense of where the Fed's going next. We've got the Fed cutting rates all the way in October as some of the trade uncertainty starts to resolve itself, as some of the inflation impact starts to be felt. This one's tricky. If the statutes get struck down and there's nothing to replace them, you could see a lower inflation impact. Alternatively, you could even see a higher inflation impact if some of the other statutes actually raise the average protective barrier on trade. So I think for the Fed, this really means do as little as possible, stay as little as possible for now, until we get a clearer sense of where growth and inflation are going. And unfortunately, we just don't have that clarity at the moment.
All right, with that lack of clarity, what's a read through the markets? Obviously, we've seen interesting moves in the bond markets recently. We thought the tariff story was calming down. Then we had the big, beautiful bill story. The U.S. dollar's been weak. What's the read through there?
Yeah, and that's a great point. We saw equities, for example, start the day a lot higher overnight and have since faded. Part of that was due to a weaker downward revision to consumer spending in the Q1 GDP print. But part of that is also just the expectation that this isn't the end of trade uncertainty. This is really just another step in it. If there's another statute that replaces IEPA, that's just going to inject a lot more uncertainty into things. I think for markets, this just means a whole lot more volatility. Probably rates continuing to chop around. Our view is lower by the end of the year, but with a lot of vol in the process. For equities in the dollar, I think that means quite the same. Our view is the dollar should continue to weaken over the course of the year. But again, over the next, call it, couple of months, we could see a whole heck of a lot more volatility as we really get that path straight, or at least get a better sense of where things are going.
Lastly, I'll ask you, what does that do for investor confidence? There's been a lot of questions about the investability of the United States after years about performance. How is the market feeling?
highly uncertain, I would say. I hate to use the word uncertainty again, but it's really not just investors, it's businesses as well as consumers. One of the things we've been keeping a very close eye on is consumer confidence, business confidence, and really how that translates into investor confidence as well. We've been seeing a pretty significant slug in the business and consumer confidence, and really that could translate into softer growth, which is what we're looking for in Q3 and Q4, as all of this uncertainty really starts to weigh on consumer spending, on investment, for example, from companies. So really, in my mind, the fact that we're in the eye of the hurricane kind of injects even more uncertainty into this whole process. And if you're a consumer or a corporate and you're really trying to make your way through this and make some long-term plans, this really just doesn't allow you to do that. You kind of have to live one day at a time. And that's exactly how markets are living, one day at a time with lots and lots of vol in the process.